Imagine you sold your Toronto condo. The market was on your side, and you just walked away with what you think is a life-changing profit. You are already planning your next move, a new vacation, or maybe a new investment. Then a letter arrives from the Canada Revenue Agency, and they are not writing to congratulate you. They are demanding 13% of the entire sales price of your property, the profit that you were celebrating. It's gone, and you might even owe them more. This isn't a scare tactic. It's a harsh reality for a growing number of Toronto Airbnb hosts. In this video, I am going to show you exactly how this multi-$100,000 tax trap works, and more importantly, how you can avoid it. Alright, let's get right into it. When you sell your home in Ontario, the sale of a used residential property is normally exempt from the 13% HST tax. It's something we all take for granted. But thousands of property owners in Toronto who use the platforms like Airbnb and Vrbo are making a dangerous assumption. They are assuming their property is still a residential property. The CRA is now starting to see things very differently. If you have been renting out your property on a short-term basis, the CRA can actually reclassify it in their eyes. It's no longer a home. It's a commercial asset basically operating like a hotel. When you sell a commercial asset, that sale is a taxable event subject to 13% HST. This isn't some brand new law. It's a new and aggressive enforcement of the existing rules, backed up by recent court battles and have sent shockwaves right through the real estate community. The CRA is actively looking for this, and sellers are being caught completely off guard with devastating tax bills. For anyone thinking this is just a theoretical threat, let me introduce you to some court cases. This case is a flashing red warning light for every single short-term rental host. Here's the story. A company bought a condo in Ottawa back in 2008. For 9 years, they did everything by the book, renting it out with traditional long-term leases, each one longer than 60 days. No problem at all. But in February 2017, they switched gears. They put the condo up on Airbnb and rented it out exclusively on short-term basis for the next 14 months. In 2018, they sold the condo, believing it was a residential complex, and they didn't collect or remit any HST. The CRA disagreed and hit them with a bill of over $80,000 in HST. The owner fought it, arguing that for 90% of the time they owned it, the property was a long-term rental. That has to count for something, right? Wrong. The Tax Court of Canada and later the Federal Court of Appeal sided firmly with the CRA. The court's logic was brutal and clear. It didn't matter what the property was for the last 9 years. What matters is its primary use at or near the time of sale. And that final stretch, it was operating like a mini hotel, and therefore the sales was taxable. This ruling set a powerful precedent and is being applied right here in the streets of Toronto. So, how does the home legally become a hotel in the eyes of the taxman? It boils down to two things: the change in use rule and the definition of a residential complex. Under Canada's Excise Tax Act, a residential complex is exempt from HST on its sale. But there's a critical exemption hidden in the fine print. A property is not considered a residential complex if it's being used like a hotel, motel, or a lodging house, where all or substantially all of the rentals are for periods of less than 60 days. So what does this all substantially mean? The CRA officially interprets is 90% or more. This is the 90% trap. If 90% or more of your rentals or stays are under 60 days, your property can lose its residential status and be deemed as a commercial operation. The moment you switch from primarily long-term rental or just having there yourself to primary short-term rentals, you trigger what the CRA calls a change in use. At that instant, you are considered to have sold the property to yourself at its fair market value and immediately bought it back as a commercial asset. This is a technical tripwire that makes the future sale of your property subject to HST. As the court case proved, even just 1 year of intense Airbnb actively before selling can erase 9 years of history. And here's where a big problem turns into a potential financial catastrophe. The 13% HST is not calculated on your profit. It is calculated on the entire sale price of the property. Let's run the numbers, because this is where the reality of a situation truly sinks in. Say you bought a condo in Liberty Village for $600,000 a few years ago. You have been renting it out on Airbnb and doing pretty well. Now you sell it for $1 million. You are thinking you have made a handsome $400,000 profit. But then the CRA letter lands in your doorstep. Because you fall into the 90% trap, you owe HST. That's 13% of $1 million sales price, which comes out to be a staggering $130,000, and you owe this tax whether you remember to collect it from the buyer or not. Suddenly your $400,000 profit is slashed to $270,000, and that's before even calculating the capital gains tax or real estate fees. Now, let's look at the truly terrifying scenario. What if you sell at a loss? Let's say you bought at the peak for $1.2 million and now the market conditions force you to sell for $1 million. You have already lost $200,000. The CRA does not care. They will still deem 13% of that $1 million sales price, another $130,000 tax bill. You are now out of pocket for $330,000. This is how sellers can lose everything. It's a tax on revenue, not profit. And it can turn what you thought was a great investment into a personal financial crisis. I know a lot of Toronto hosts are probably thinking, but I follow the city rules. I only rent out my principal residence and I stay under the 180 night cap. And it's true, Toronto has its own strict regulations for short-term rentals, like mandatory registration for a 180 night annual cap for the entire home rentals. And that is your principal residence. Following these city bylaws is absolutely essential. And it does help establish that the property is your principal residence, which is a strong piece for your defense. However, this is critical. Complying with the city rules does not make you immune to federal tax law. The CRA and the City of Toronto are two separate entities. The city cares about housing and neighborhood issues. The CRA cares only whether your activity is personal or commercial. If the property is not your principal residence, if it's a second or third property you own purely for investment, then the 180-day rule is irrelevant to the CRA. They will look purely at your rental pattern. If over 90% of your rentals are for less than 60 days, you are squarely in the danger zone. No matter which city bylaws you follow, don't let compliance issue with one rule book give you a false sense of security about the other. Okay, that was the scary part. The good news is this tax trap is completely avoidable if you plan ahead. If you are a short-term rental host in Toronto, here are 5 steps you need to take right now to protect yourself. First, know your numbers. You have to meticulously track the usage of your property. I am talking about a spreadsheet where you log every single night. Categorize each night as either personal use or short-term rental, less than 60 days, or long-term rental, 60 days or more. This documentation is your single most important piece of evidence to fight a CRA reassessment. You need to prove you are below the 90% short-term threshold. Second, engineer a cooling off period. If you have been running your property like a hotel, you are thinking of selling, you need to deliberately change it back as a residential well before you list it for sale. The court case showed just how 14 months of short-term rental was used enough to trigger a tax. To be safe, convert the property to a long-term rental with a tenant on a 1-year lease, or move in yourself to make it your principal residence. The longer the period of a clear residential use before a sale, the stronger your case for the HST exemption. Third, your principal residence is your shield. If the property is genuinely principal residence, act like it. Live there. Comply with the Toronto's 180 night cap. The principal residence exemption for capital gains is a separate issue from HST. But actually living in the home makes it much harder for the CRA to argue it's just a commercial hotel. Fourth, be careful with your expenses. When you file your taxes, you can claim expenses against the rental income. But if you start claiming input tax credits, ITCs, claiming back the HST you paid on things like cleaning or furniture, you can effectively raise your hand in telling the CRA you are a commercial operator. This can be used as evidence against you when you later try to claim that property as a residential. Talk to an accountant about the long-term risks of claiming ITCs. Fifth, and this is your most important one, get professional help. This is not a do-it-yourself tax situation. Before you even think about selling, you must consult a property tax professional, especially an accountant who specializes in GST, HST on real estate. They can analyze your situation, tell you your risk level, and help you build a plan to avoid this tax. The cost of their advice is a tiny fraction of the 6-figure bill that can arrive. If you have found this information helpful, please subscribe and hit the notification bell. If you are thinking of buying or selling real estate in the GTA, please give me a call. My contact information is in the description below. The 13% tax trap isn't a myth. It's real. It's happening right now in Toronto, and CRA is just getting started. The days of casually running a full-time Airbnb and assuming you can sell your property tax-free are over. The courts have been crystal clear. If you operate like a hotel, you will be taxed like a hotel. Ignorance isn't a defense, it's a liability. The only thing standing between your hard-earning equity and a massive, unexpected bill from the CRA is being proactive and planning and getting legal expert advice. Protect your investment, know the rules, document everything, and get the right team on your side before it's too late. The CRA needs money and they're coming after you. Until next time, see you soon.